Hello, my name is Elliott, and I'm the editor of Personal Finance as well as The Energy Strategist and co-editor of MLP Profits with Roger Conrad. Today I want to talk about one of the most exciting developments underway in the oil market, and that's really a number of horizontal oil plays that have been discovered or retooled in the United States over the past decade or so. Just 10 years ago, production from the states of Montana and North Dakota was declining. Actually, oil production from those two states had been declining since the 1980s. And really not very exciting states, or weren't regarded as very exciting states in terms of potential growth in oil production. Just not much in the way of reserves. But the discovery and development of an enormous shale find called the Bakken shale has really revolutionized that. We've seen an absolutely parabolic growth in oil production from the Bakken shale in the United States, particularly in those two states, mainly North Dakota, but also quite a bit of emerging activity in the state of Montana. By 2015, some companies are estimating that we could see these two states actually producing north of 1.5 million barrels of oil a day. That's up from about 300,000 barrels of oil per day right now, and it's up from around 100,000 just a few years ago. So we're seeing really tremendous growth in these two states' oil production, and it all comes down to the secret being is Bakken shale. What is a Bakken shale? Well, a lot of people confuse oil shale with shale oil. Oil shale is really something that was developed in many ways, a lot of times over the course of history, but one of the biggest development surges came in the early 1980s. ExxonMobil invested heavily in some oil shale projects. It's really a solid form of oil. You heat it underground, and it's actually a very poor form of oil. It requires a lot of upgrading to be actually usable like normal crude oil. It's actually an earlier stage in the petroleum production process, genesis process, than the bitumen, which makes up Canadian oil sands. It's extremely expensive to produce. Most companies are saying that you really would need to see $100 oil to see oil shale be economically viable. And I think we'll see oil at those levels, but you really need to see it sustained above $100 before you're going to see a lot of interest in these areas. In fact, ExxonMobil, which as I mentioned invested very heavily in oil shale back in the early 1980s, abruptly pulled out almost overnight. And they'd built an entire town which they thought might actually have 50,000 people in it at one point. And they totally backed out and wrote off more than $1 billion of investment because oil prices dropped from very high levels in the late 70s and early 80s. And it no longer became viable to do oil shale. Shale oil is something totally different. Many of you have already heard of shale gas, places like the Barnett Shale, the Haynesville Shale, the Marcellus Shale, which is in the east in Appalachia, and the emerging Eagle Ford Shale in South Texas. These are plays that are producing gas from a shale reservoir, basically shale rock. Now the thing to keep in mind with shale is that a more traditional reservoir rock would be sandstone. And if you've ever looked at a piece of sandstone, it's exactly what the name implies. They're loosely consolidated bits of sand, have a lot of pores and cracks in that rock. And what that means is that the gas is actually held in those pores, or the oil, and when you drill a well, because that gas or oil, those hydrocarbons are under pressure, it naturally flows through that rock and into the well. The problem with shale is that it's a much denser rock. Think of it as basically clay in a solid form, and you'll kind of get an idea. Though it has a lot of cracks and crevices in it, which contain oil or natural gas, it's almost impossible for that natural gas or oil to flow into a well because there are no cracks that actually connect those pores. There's no natural pathway for that oil or gas to flow through the rock. So what's happened in the past 10 years is that two key technologies have been developed that have made these plays economic. They are horizontal drilling and hydraulic fracturing. Horizontal drilling, as the name implies, is simply drilling a well sideways underground. If you think about it, layers of rock are deposited sort of in layers that are parallel to the surface of the earth. So the productive layer, say in a play like the Haynesville Shale in Louisiana, might be 200 or 300 feet thick. If I drill a vertical well, only about 200 or 300 feet of that well is going to actually be exposed to the gas-bearing reservoir. But think about it if I drill down and then sideways through that gas-bearing formation, say for 5, 6, or even 10,000 feet, then I'm exposing a much larger segment of my well to that productive area. So that's the first key technology. The second key technology is hydraulic fracturing. Hydraulic fracturing simply involves pumping a liquid under very high pressure into the well. It moves into the reservoir rock and actually physically cracks that rock, fractures that rock. This creates pathways for the oil or gas to flow through the reservoir and into a well. So those are the two key technologies to keep in mind. Now what's happening is that though most of what we've heard of in the last 5 or 6 years has been shale gas, which as many of you know has revolutionized the American gas industry, the United States is now the world's largest producer of natural gas. We produce almost as much gas as the entirety of the Middle East and Africa combined. Just to give you an idea. We overtook Russia a couple of years ago to be the world's largest gas producer, and it all because of the development of these vast natural gas shales. But what a lot of people have heard less about is the fact that this is not only applicable to gas. There are also oil shales out there, reservoirs that contain oil that can be produced in the same way using hydraulic fracturing and horizontal drilling. Now this oil is not bitumen like oil sands. This oil is not oil shale. This is regular crude oil. In fact, it's light sweet crude oil in many cases. The most high value crude oil you can get. In some cases, it actually trades at a premium to West Texas Intermediate and Brent crude oils, which are the two oils that you hear about on financial television and you see the price of every day. So this is even better oil than that. It just happens to be trapped in a shale rock formation that has to be drilled horizontally and fractured. We're hearing about amazing growth in this industry. A couple of companies that reported earlier this week actually came out and said that they're seeing very strong growth in demand for these key services, horizontal drilling and fracturing, and it's all coming from these oil plays. You know, a few years ago, most land rigs in the United States, the vast majority of land drilling rigs in the United States were focused on natural gas. Now it's almost 2/3 are actually focused on drilling for oil. So we're seeing a tremendous growth in demand for these services. We're also seeing tremendous growth in production from key shale plays in the United States, like the Bakken shale in North Dakota and Montana.